touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Good morning. You're watching All You Need to Know on Bloomberg Quint Live, India's first digital live streaming business news service. I am Agam Akil. First, the headlines. Asian markets are set to end the week on a sour note after US President Donald Trump stoked fresh trade war concerns. US President Donald Trump says that he will not meet Chinese President Xi Jinping's before the March 1 deadline, intensifying fears that a trade deal between the two nations is unlikely before the 90-day deadline. An impairment loss for its subsidiary Jaguar Land Rover led to Tata Motors reporting a whopping 28,000 crore loss in the third quarter. The company's ADR ended 10.5% lower. Three Nifty companies, Tata Steel, BPCL and Mahindra & Mahindra, will report their third quarter numbers today. And lenders to SR Group's power companies have filed recovery cases to invoke personal guarantees of promoters. Two people in the know have told Bloomberg Quint. The Dow's midweek sell-off took an even steeper turn on Thursday after White House economic advisor Larry Kudlow broke from the Trump administration talking point that the United States and China are close to reaching an agreement to end the trade war between the new tariffs kick in at the beginning of March. Abigail Doolittle of Bloomberg News sums up the entire Wall Street session in this report.
Stocks sold off in Thursday's Wall Street session, with each of the major averagers of the Dow, the S&P 500, and the Nasdaq down about 0.9% or more, with that tech-heavy Nasdaq once again underperforming, down 1.2%. So clearly a risk-off tone as investors are worried again about the global growth prospects. But there, of course, has been a big risk rally for stocks this year. January, the best January for the S&P 500 in 32 years. So a little bit of a pause in that rally. Investors taking some chips off the table. Now, the risk off that we saw for stocks, though, confirmed when we go cross asset class, considering that the commodity complex was also lower by more than 1%, while this was confirmed by Haven bonds rallying. So again, a risk-off tone, and beneath the surface of the S&P 500, the sector situation was also somewhat bearish. 9 of the 11 sectors for the S&P 500 declining. On bottom, energy down more than 2%, in sympathy with oil falling on the day by about 2.5%. Technology and the financials were also weak. The only two up sectors on the day, real estate and utilities, those are defensive sectors. So in a way, that's even bearish in and of itself. As for notable movers, Twitter was down 9.8% on a soft guide for the first quarter. The FANGs were also lower overall by nearly 2%. Facebook, Amazon, Netflix, and Alphabet falling as a whole. The chips were down, underperforming. Micron and Marvell, some of the bigger laggards in that space. One bright spot, Chipotle Mexican Grill, up 11.4%. This on a big beat. They did beat adjusted earnings by 24% as turnaround hopes and digital prospects continue to help that company. Rewarded with investors again sending the shares of Chipotle Mexican Grill up by 11.4%. But overall, Thursday's Wall Street session was risk off. In New York, Abigail Doolittle, Bloomberg News.
On that note, let's go straight across to Bloomberg's Rosalind Chin, who joins us from the Hong Kong studio with all the live market action in Asia. Rosalind, Happy New Year.
Happy New Year to you. Yes, we are seeing some of the markets coming back now after the Lunar New Year holiday. Hong Kong, of course, is one of those, just opening for trade after a 3-day break. And what we see is that Hang Seng Index down 1.25% right now. So what we're actually seeing is a lot of that unease over trade and the situation between the US and China, where that is concerned, coming back in as investors start to question whether any kind of trade agreement can be made in the near future or at all. So we are seeing that Donald Trump has been saying it's unlikely now that he's going to meet Xi Jinping before March the 1st. That is the date in which more tariffs will be imposed on on Chinese goods going into the US. So we see that's affecting the region as a whole. The markets which are open include the Nikkei and topics that those are both losing by more than 1%. Around the region, we also see the Aussie markets, the S&P ASX 200, also losing by about 0.25%. In Japan, we saw the topics, in fact, raise its weekly advance. Automakers amongst those there which are dragging. And we saw that the yen as well, of course, holding on to its overnight gains as risk aversion again because of those trade issues coming into play there. The Aussie dollar sliding to a 5-week low. That's after the RBA downgraded its outlook for growth and inflation. Earlier this week, we did see the central bank governor say that they were declaring a shift to a neutral policy stance. So we're also seeing Aussie bond yields sliding, threatening to, in fact, widen their deficit with US Treasuries beyond the record set during the flash crash that we saw in early January. The S&P ASX 200, as I mentioned, losing by about 0.25%. So we are seeing volumes coming back in now after the Lunar New Year holiday. Still closed, though. China, that comes back online on Monday, Taiwan and Vietnam. So we are seeing slowly a return to regular business here in the Asia region. Back to you.
All right, Rosamund, thanks for that. But moving into the U.S. now, the U.S. President Trump said that he would not meet the month with the president of China, Xi Jinping, raising new concerns that the United States will not be able to complete a trade deal with China before American tariffs increase on March 2nd. Bloomberg's Stephen Engel has more details in this report.
There are two big issues on both of those fronts, of course. I mean, the June summit we had with Kim in Singapore did not net a lot of deliverables, really, other than vague promises from Kim Jong-un. So there are still lots to be done on that front. So if there was going to be a Kim-Trump summit followed quickly or preceded by a Trump-Xi summit, one of them would likely be lost in the wash, and that would likely be the Trump-Kim summit. So these are issues that need to be addressed wholly and individually, and it's probably a good thing that Trump is putting off a meeting with Xi Jinping to address those issues between the two largest economies in the world for a later date. Now, we're hearing that, Donald Trump, of course, has said they are not going to extend the trade truce deadline beyond March 2nd. However, the likely resolution would be that they would have to delay that imposition of the extra tariffs from 10 to 25% on an additional $200 billion worth of goods. Now, we're not sure when they might meet down the road. We're hearing from economic advisor to the White House, Larry Kudlow, says a Trump-Xi meeting is off in the distance, quote unquote, but he added that so far they are getting a good vibe in the trade talks, and we're getting Steve Mnuchin as well as Robert Lighthizer, the U.S. Trade Representative, heading to China next week to continue these talks. But keep in mind, if they were going to meet that deadline of March 1st, it was likely going to be a Band-Aid resolution, China pledging to buy more products from the United States and addressing the easiest issue of them all, and that is the trade deficit, instead of the bigger long-term reform issues that the Trump administration wants to address with the Chinese. And that, of course, is intellectual property rights violations, as well as forced technology transfers and state support of key industries.
Well, has it had an impact on our opening, or will it? Well, let's start by taking a look at the SGX Nifty, which is currently trending downwards by as much as 35 odd points. For our own markets, we saw the Nifty flat, and we, however, did see some strength in your broader markets like the mid-cap and the small-cap indices, with the banking indices also largely showing weakness. In terms of ADRs, we have severe weakness in Tata Motors, which was down around 9.5% after very weak earnings, especially from the Jaguar Land Rover stable. And in terms of other ADRs too, if we can have that slide, we have marginal gains for HDFC Bank, Dr. Reddy's and Wipro. But when it comes to your foreign institutional flows, again, continues in flow at around 418 odd crores. DI is also by stock worth around 294 odd crores. And we do have a very little change with respect to the Nifty. So ITC, Sun Pharma and Maruti are balancing out some massive losses in Reliance Industries, HDFC and Larsen and Toubro. In terms of futures and options, we continue to see a lot of position building, but which eventually tapered off. So we actually landed up with not more than 0.5% gain in open interest for the Nifty futures, and the Nifty banking futures did see about 1% increase in open interest. Now we have a 300-point range based on OI, but at this point in time we have maximum OI at the 11,000 call and the 11,000 put. So it's pretty crucial and critical as to where the Nifty is going to go. more writing coming along the 11,000 put, which is also a little bit of a resistance at this point in time. But should we see more weakness and the Nifty slip below the mark of 11,000, there could be some problems. And with the wicks, of course, cooled off, down by around 1.3%. And we also saw the Nifty put call ratio, well, largely on the same levels at around 1.78 for the Nifty bank put call ratio at around 1.122. And well, we do have IDBI Bank, Diwan Housing Finance, Jet Airways, Reliance Capital and Reliance Infra in F&O ban, but Reliance Power now joins these companies in the F&O ban, so that's the new entrant. Of course, save for the ADG stocks, we have a lot of traction in Muthoot Finance as well as Manappuram Finance, both of them advanced in fresh longs. And moving on to your, those stocks which are unwinding, we had ICICI Prudential, possibility of Reliance Infra and Reliance Capital also seeing a lot more movement considering unwinding. But on that note, now let's see what's making headlines across the globe. Sue Keenan of Bloomberg News brings us the first word headlines.
Theresa May, who has failed to make any breakthrough in her latest Brexit talks in Brussels. She and the EU officials agreed on more negotiations by the end of the month to try to break the impasse that threatens a no-deal divorce. With just 50 days to go until Brexit, May is damaging, or I should say demanding, changes to the so-called Irish backstop to help her deal pass in Parliament. The EU, however, will not budge and is warning of the dangers to come.
It was a valuable meeting, but we are very concerned. We are weeks from an economic and human catastrophe. This is the reality of a no-deal Brexit. Should be a very dangerous solution.
The Bank of England has added to the Brexit gloom by saying the uncertainty is sweeping through the UK economy, businesses and households. Delivering its latest inflation report, the bank offered renewed pessimism, with Governor Mark Carney saying the fog of Brexit is racking up the tension. Even with a smooth split, the BOE still agrees or sees the UK economy growing at its weakest pace in a decade.
The fog of Brexit is causing short-term volatility in the economic data, and more fundamentally, it's creating a series of tensions in the economy. Tensions for business. Although many companies are stepping up their contingency planning, the economy as a whole is still not yet prepared for a no-deal, no-transition exit.
Reports from Iran say that the Revolutionary Guard has developed a new surface-to-surface missile with a claimed range of 1,000 kilometers. The weapon is said to be a version of an existing missile with a lesser range, and it coincides with the 40th anniversary of the 1979 Islamic Revolution. Iran has missiles capable of flying 2,000 kilometers, and that is enough to strike Israel and U.S. bases in that region. Amazon boss Jeff Bezos is accusing the National Enquirer of extortion and blackmail. The tabloid published an expose of his alleged relationship with TV personality Lauren Sanchez, and he has hired investigators to find out if the story was politically motivated, given his ownership of the Washington Post, a critic of President Trump. Bezos says the Enquirer threatened to publish revealing photos if he does not stop the probe.
Well, here are the top 5 takeaways from the Tata Motors earnings. The one-offs do not stop coming in and impacting Tata Motors quarterly earnings. This time on a consolidated basis, because of one-offs, we had a big 27,000 crore loss. Not only that, we had the JLR impairment, which is bullet number 2, which clearly impacted the overall profit this time. A 3.1 billion pound impairment that was relating to China. The management believes that there is a revaluation necessary for the Chinese assets, because of which there was the impairment charge taken, which was non-cash in nature. Again, if you look at the operating performance also was dismal. On the operating basis, the EBITDA margins for JLR entities stood at 7.3% versus the street expectation, which was upward of 11%. So the operating margins again disappoint because of the stress in China, as well as the Brexit situation, which is impacting the sales in Europe. Not only that, we have the JLR EBIT margins, which came in at a minus 2.6%. This is revised, by 100 100 basis points, which is basically the targeted range. Earlier, the management expected that the EBIT target range should be in the range of 4 to 6%, and now they have revised this downward to a level of 3 to 6% because of the demand concerns both in China as well as in the European markets. And finally, despite all of the noise and all of the write-off, the management does believe that they are on track to achieve a 2.5 billion British pound cash and profit improvement by March 2020. And that is something which stood as a silver lining to the quarterly earnings. But let's listen in to the group CFO P. Balaji and what he had to say to Bloomberg Quint with regards to the credit rating, which can get impacted because of the quarterly earnings. And also he spoke about the Chinese markets and the EBIT targeted range that he expects moving ahead.
It's a non-cash charge, as you rightly call out. Number two, it's a 6 billion net worth after the impairment. My gross debt to equity is 0.78. My financial covenants, most of them, there's almost no financial covenants on my net worth. So therefore, we are confident. And more importantly, I think it's also about understanding what is happening in this, because if it is about what is the real value of the assets that you're carrying, this actually confirms what is the real value of the asset that people should be looking at. From those assets that are currently in use, forgetting about future assets, future investments, future growth, all that. From an EBIT margin range, we have calibrated to a 3 to 6%, reflecting the challenges that you outlined in terms of China and others there. At the same time, our long-term margins intact because we believe it will be a temporary. Business will get back to normal. And at the same time, the work on charge and the work on the corrections we are making in China, as well as other business interventions we will anyway be making, and the kind of exciting products that we are landing, because we have Evoque lands now, we have the new XC coming in, thereafter we have the entire the Defender coming in. So we got a rich pipeline of products that are coming in, and therefore the combination of these two makes us quite confident that this is a realistic plan.
Well, BPCL on a standalone basis compared to last quarter is expected to report a weak set of numbers. Now, if you see the headline numbers for BPCL, the revenue is expected to be down by nearly 2% to close to 70,600 crore rupees, while the net company is also expected to report a net loss of close to 1,400 crore rupees as against a net profit reported by the company in the last quarter of close to 1,200 crore rupees. EBITDA is expected to fall by nearly 83%, while the margins are expected to come in as low as 0.6% for BPCL. Now, the gross refining margin, that is the key number for the oil refiner, that is expected to come in at negative $0.5 per barrel as against $5.57 per barrel reported by the company in the last quarter. It is expected to be a weak quarter for BPCL on the back of lower GRMs, that is the gross refining margin, and higher inventory losses. In fact, on an operational basis also there is chances that the company might report a loss. Now, the Singapore gross refining margin, that is the Asian benchmark, that averaged lower at around $4.3 per barrel versus $6.1 per barrel in the last quarter, while the Brent crude averaged around $68.81 per barrel, and that's the reason why the company is expected to report a weaker GRMs and a higher inventory losses in the third quarter of financial year 2019. However, the rupee appreciation could lead to some foreign exchange gains and help the company in the third quarter of financial year 2019. Now, along with this, some improvement in marketing margins could also aid the numbers in the third quarter. Now, the gross marketing margin earned by BPCL on sale of every litre of petrol, now that averaged around 3.6 rupees per litre, while on diesel that averaged around 3.2 rupees per litre, higher compared to last quarter where it was 1.6 and 2.2 rupees per litre on petrol and diesel. On the operational side, if you see the crude throughput, that is expected to be flat at around 7.56 million metric tons, while the sales are expected to be higher by nearly 13% to close to 11.35 million metric tons in the third quarter. Now, the key things to watch out for from BPCL earnings would include the company's crude sourcing strategy, along with that any guidance on the future capital expenditure, their outlook on the gross refining margin, and any updates on the Mozambique and Brazil field development plans would be keen thing to watch out for from BPCL earnings today.
Well, all eyes would be on Tata Steel, the fourth steel maker, which would be reporting the Q3 numbers today. We saw a stellar performance coming in from SAIL. So what we're expecting from Tata Steel, at least on year-on-year basis, is at least good set of numbers. Top line, we're looking at a 20% growth out there. EBITDA performance is expected to register a growth of around 25%. The margins are expected to stay around that 17% kind of a level, and profitability of the company is also expected to inch higher, more than 70%. 20% on sequential basis, given on account of higher steel prices, at least that we've seen on year-on-year basis, which in turn is expected to percolate down well in terms of the realization of the company and aid the operationally unitary performance of the company. HRC prices have risen as much as 20% year-on-year basis, but then notably, sequentially, the prices have actually contracted by 2.5%, which in turn, this contraction is expected to weigh down on Tata Steel's earning sequentially. We are not expecting great figures coming out of volume front, especially because the company's sales volume standalone basis was at least at 18-month low for January or for the December quarter that was reported by the company. So here on, we're not expecting a good sales volume. At least Bhushan Steel Power performance sequentially is not expected to be great either. However, we are expecting a subdued performance also coming in from the Europe business. Net-net, we're looking at a contraction coming in on sequential basis on account of lower prices and cost escalation. Key things that we like to keep an eye out first would be the imports from China and the global iron ore prices. We definitely look for commentary on steel prices after Brazil's Wales decommissioning, updates on Bhushan Power and Steel, and also the Thyssen Group steel merger. Besides that, we got to watch out for sales volume, given that Tata Steel kind of raised a lot of concern by reporting its December quarter sales volume number this time around.
Like most of the auto companies, this time for Mahindra & Mahindra plus MVML entity, we are expecting a muted quarter on the profitability front. And despite a 14% growth in revenues, we are expecting the EBITDA to grow only by 7% at a level of 1800 odd crores. Profits also seen close to 990 crores. That will be a decline of nearly 3% on a year-on-year basis because of lower other income as well as higher tax outgo. Margins also will be contracting by nearly 100 to 90 basis points to come in at 13.8% this time around for the M&M plus MVML entity. Of course, the key factors that will be driving the earnings this time will be 11% jump in the overall UV volumes as well as tractor volumes. 1 or 2% realization growth is expected on the back of price hikes that the company has recently taken in Q3. And also the key factors to watch out for apart from the earnings would be the management guidance on the tractor volumes moving ahead, because we have seen not only the commercial vehicle segment see slower growth, in fact declining growth, but the tractor segment also is indicating a flattish trend moving ahead. So the management commentary on the demand trends for the new launches as well as the tractor demand is something important we'll be watching out for in M&M.
Good morning. So these are the bunch of stocks we need to keep an eye on today. Let's start with the earnings. Britannia came in with a set of inline numbers. They had a volume growth of 7% on a strong base. While the core business was steady, the subsidiaries lagged. Then comes Aurobindo Pharma, which came in with a good set of strong numbers. The financials were above all Bloomberg estimates, and they had a good performance across geographies, US being the strongest. The only negative was their gross margin that declined by 240 BPS due to adverse product mix. Then we have SAIL, which also came in with a strong set of numbers. They had a strong operating performance aided by cost controls, and a higher prices support profitability expansion. Sandur Manganese also came in with a strong set of numbers. Their revenues were up 28%. Net profit was up 76.6%. EBITDA was up 68%, and margins were high at 28.6%. Apex Frozen Foods again came in with a strong result. Their revenues were up 2.8 times. Net profit was up 2.6 times. EBITDA was up 3 times, and margins were at 10.6% compared to 9.7% in the last quarter. Khadim was the only one that came in with a weak set of numbers. Their revenues were down 13.8%. Net profit was down 55%. Basically, all the numbers were below the estimates. And we also need to keep an eye on Coffee Day Enterprises. The board is approved to sell their shares to the promoter Mindtree. So they might be focused on Mindtree today, though the date of sale is not disclosed yet. Now let's look at the block deals. So we saw yesterday that a bunch of ADAG stocks fell down significantly. After market hours, we got to know that L&T Finance was one of the big sellers for ADAG stocks. Thank you.
there's lots to talk about over the course of the day, and you will find all the live market action on Bloomberg Quint. There are also a few stories that you should consider reading on the website bloombergquint.com. Here they are. India's richest man, Mukesh Ambani, announced an over 10,000 crore investment in West Bengal for expanding his firm's telecom network and towards a new e-commerce venture. And according to the RBI's Consumer Sentiment Survey released yesterday, confidence levels were at their strongest in 2 years in December, while confidence over the current economic situation has improved moderately. Consumers are more buoyant about their expectations over the next 1 year, the survey has suggested. The State Bank of India, the country's largest lender, said that the Reserve Bank of India slapped rupees 1 crore penalty on it for violating norms. And on that note, it's a wrap on this edition of All You Need to Know. Stay tuned to Bloomberg Quint for more news and updates.